Hey, good afternoon. This is Trader Tim from EminiMind. Today is September 30th, last day of September, and we are doing a trade recap video. Before we get into the intraday stuff, let's touch on the daily ES here. You can see we closed down at lows of kind of the same lows that we were at last week at this hammer, and we have the potential to continue down to the negative 23. However, tomorrow, if we do gap up at lows and then we break that first 15-minute candle's high, that gap up at lows, that would be the phrase I would use. We could go into kind of a strong rally situation, and if you look at the 24 hours worth of data, you can see this smaller retracement from just what was that, Tuesday's candle, the high of Tuesday to the low of Tuesday, using the 24 hours worth of data. That traded this morning at the 50% retracement. And so we may, get a bounce up to the next 50% retracement. If we gap up to that point, it doesn't necessarily mean it's a gap and go until we get the follow through. So I don't like to just jump in right on the open. I like to give it 15 minutes and then make that decision. So watch for a potential gap up tomorrow. But with all the stuff that's going on here, especially in the U.S. and China, things should stay a little bit more volatile over the next couple of weeks. Which, for us intraday traders, that's actually really good. As far as like your long-term accounts and stuff, like you really don't need to panic. As far as like, oh, do I need to close out my whole portfolio and sit in cash? Pretty difficult to sell at the high and then turn around and buy back at the low. So if you've got money in a retirement account and you're not of retirement age, or you're not even at the point where you need to pull all your money out, even if you are at retirement age, there's really not a lot to fret about when you get these market declines. You just end up reinvesting the dividends at lower prices, and then when the market goes back up, your account is higher than it was when the market was up here the last time. So let's get into some of the intraday stuff. You'll notice if we go back to just the trading hours only here. Whoops. We started the day with an intraday candle. And so this morning we're sitting up here in an inside bar, not an intraday candle, an inside candle. And anytime we're in a situation like this where we are underneath a 50% retracement on the daily, and things are kind of uncertain or scary out there in the markets. There's all this news going on about potential bad stuff that could happen. Buying or selling the halfway back of the day is a really good play. It might seem like intraday everything is all well and good, especially like in the morning if you do make that push higher, but it's worth it to look at the halfway back of the day, and this morning it looks something like that. And so, market comes down, you could say, well, we made a double bottom here, but keep in mind that on the daily chart, we're still in that halfway back short. We're still in that larger downtrend with, a lot of very recent down moves. And so this one was a little bit later in the morning, but we did set up really, really nicely. You'll notice too, so if we back up and start with the very first retracement long coming from yesterday's close to this morning's open, that 61.8 lined up beautifully. So we failed over here, and then we turned around, and so that kind of support ended up being resistance, coincidentally at the same level, and that was back it up here. It was right here. So about 2 hours into the day, sold off from that 50%, and then the 512 had a nice touch here at 43.52, and then we really started a nice slide lower. So the daily chart, even though you might just be intraday trading, it is helpful to look at where are we within the trend of the daily chart. We opened here. The negative 23% target is all the way down here. If we were trading down at the negative 23% target, I wouldn't be so interested in getting short. There are situations where, we go to the negative 23 and then we just keep going down to the negative 61.8. But when we're up, I would call this like the upper third of the 50% retracement short. We're just kind of starting to get going, and that's a good place to watch for the bounce to short that bounce. So this morning we opened up, we were inside of yesterday's range. It's always a little bit hard place to be because there's a lot more back and forth. And then Tuesday we were talking about, actually I'm going to delete all of this and we'll redraw it. So on Tuesday I was talking about what do you do when you're stuck between the two 50s, two 50%. And what I mean by that is if I draw a retracement like this, so that was the first one I drew coming into the day with the overnight data turned off. So this is just the trading hours only data. And we came down to the long, and then upon bouncing at the long here, we stopped at the short. And so what you don't want to do is to try and trade in the middle of this range. So we have these two 50% retracements, the two yellow lines. We've got a short up here and a long down here. If the distance is large enough between the two, so we've got about a 59 up to a 65, we'll call it. So 5-6 points. That's enough to get a first target of 3 points. So if you are going to take the risk and go long at a 50%, or in this case, the way it's set up, the long traded first, and then we went up to the short, and if you're thinking, okay, I'm only going to take shorts today, and you want to take the risk, take the trade at the 50% short, at least you know if we are met with support at the other end, meaning this long down here, I'm going to at least get a first target of 3 points. That's what my first target is. So 2-point stop, 3-point first target, trail the rest. And so this way, you're getting that first target, and you're basically in a guaranteed winning trade. If we draw up the next long like this is where you don't want to trade, in the middle of that range, in the middle of these two 50s. If you try taking a long here, you get stopped out. You try taking a short here, you get stopped out. So stay away from the middle of 250% when they're opposing like that. Stay away from the middle of that and just look at the top and the bottom of the range. If we then move a little bit forward and you say, okay, well, we started to break higher, you can come in here and say, well, we broke this short, so that means the long has more participation, if you will. There was enough movement to get us to break the short for the short sellers to be overrun, if you will. So what you can do is take the next long setup that goes from just before, like the swing low before the break of the 61.8 to that high, and you can use that as a entry into the trend that has now begun to form. So really, the trend is starting down here, but we don't know that it's going to be a long trend, at least for just this short period of time, until we break that 61.8. And then, even the next one got momentum up to kind of making a double top, and even that was good for a first target of 3 points. And then when you start coming down and breaking these smaller 50% retracements, we can zoom out and come back to this larger 50% retracement long. And when that breaks here, this is the same 43.56, when that line breaks, then we can draw up the opposing short. And if you use the swing low here, we did roll over. It was just a little bit messy this first time. And so if you did let this area sort of, you see that we're getting some resistance at this 50%, and then we trade into the 61.8, but then when we sell off, you can jump in short like that, And on those situations, it's nice when the 50 and the 61.8 are a little bit closer together, because if I see us breaking through the 61.8, being real sloppy, meaning I draw up a short, we break the 61.8 of that short, but then we still go down, it's nice to have a little bit of wiggle room here. So like your 43, 59.75 as your entry, 61.75 is your stop. This one's, it's getting a little bit tight as far as your stop is just outside the 61.8. So that's just something to consider. If I see the market getting sloppy like this, or a little bit more whipsaw action and noise around the 61.8, you do risk that pattern occurring later on. So like if I drew this next one up here, you can see, oh, we broke through the 61.8 just like we did up here, and then rolled over. But at this point, a 55.50 is your entry. So you're talking a 57.50 is your stop. And, breaking through that, you're going to get stopped out before the market rolls over. So if you have a little bit more patience and draw up the short like this, a smaller retracement, notice the 50% also lines up with a slightly larger 50%, and you have a better chance of the market rolling over and you being able to stay in the trade. There's plenty of setups out there, and there's lots of times where you're right on the direction, but if you can't stay in the trade because you get stopped out or the market's just kind of chopping around, then it really doesn't do you any good. So let's see here. We talked about that next halfway back short of the day, and that is, when you're intraday trading, you don't necessarily need to come in with a bias for the day and say, this is the direction I think the market's going to go, and so I'm only going to trade this direction. But on these bigger, what I would call like macro events that are surrounding the markets. So like right now we've got the government shutdown stuff and the or potential, it's not going to at least till December, and then the debt ceiling. Those are all potentially very scary things for the market. We also have jobless claims and a lot of these numbers that are coming out from the last couple of months of data when there was a bit of a slowdown in spending. And so those things that can be a little bit scary, when you get these intraday bounces to a halfway back of the day, it's a great opportunity to look for a short. I had put on some puts on the was it the 24th? It was Monday. I think that was Monday. 27th. The 27th, yeah, before the drop. So I put on some puts here, and I had some October 1st expirations. And so I'm going to be gone tomorrow, and so I did close those out at the close today. I typically don't hold options into expiration, and those were weekly, so those are expiring tomorrow. I also don't usually go that short, but the reason I did is because I was expecting, okay, we're either going to come down immediately, like in the next day or two, or we're going to break the 61.8 and close above the 61.8, in which case I'll just get out. So when your time frame is super short, you can capitalize a lot more by going with a shorter time frame on puts like that. But usually I'm going out at least 2, sometimes 3 weeks. But the point is, your time frame is very, very important. Intraday, when we're trailing our stop and when the trades might only be lasting, 15, 20, sometimes only 5 minutes, you don't really have to go into the trade with a time frame. But when you're trading on the daily chart, you don't want to get scared out of a position by, putting on a swing trade and then getting scared an hour later and then closing it out and then just, watching it go hundreds and thousands of dollars in your favor and you're out of the position. So the other thing is, when you can pay a little bit less for a hedge, like buying puts in this case, when the market is up, you can buy more of them. Therefore, you have more to be able to scale out. So if you did want to sell some on Tuesday at the close, you would still have some to ride for the next couple of days. And you can lock in profit that way, you can reduce your risk that way, you can mentally stay in the position longer. And so just like if you were trading the micro ES and trading more contracts to practice and to get a better handle on managing multiple contracts, in the long run, that's actually going to do you a lot more good than trying to trade one, regular ES contract. You're not going to, get rich trading one contract. That's not the goal. So you're better off trading multiple smaller contracts and then being able to scale out and manage your trades more efficiently and more importantly, manage your emotions better. So if you do have questions, feel free to drop them in the comments below. I know we went over a lot of stuff here. And next Tuesday, we'll be doing another live trading session where you can tune in and we'll talk about a lot of this stuff in real time. And for everyone else that's trading tomorrow, I hope you have a great day and have a great weekend. And I will talk to you all next week.